Hey, good evening. Thank you all for joining us tonight on this, we call it an emergency update, frankly, on what's going on with the proposed tax changes from the House Ways and Means Committee that came out on September 16th. You know, we've been waiting for guidance on this ever since President Biden took office. And what he shared with the world was it scared the heck out of all of us, right? I mean, it felt as though the sky was falling, and we were all concerned about what really could be happening to the broader U.S. economy, but in particular, what might be happening inside of the dental economy, particularly with the sale of practices and what would happen with the inventory available. Everyone who is involved in this space has been tracking this story closely. And we felt obligated to bring on the experts to help us really unpack the story here and share with you how we view it and how others view it as well. Today, I'm Kevin Cumbus of TUSK Partners. Today, I'm joined by three esteemed colleagues. First is Maggie Jarrett, Director at TUSK, then Brian Coleo, Director at Dykema at the DSO Group, and Rich Lieberman, who is a tax expert extraordinaire and member at Dykema DSO. Maggie, this is your first time joining us on one of these, so I'd love for you to take a minute or two to introduce yourself.
Sure. Thanks, Kevin. I'm happy to be here today. I have recently joined the TUSK team and have spent my entire career in healthcare. The past 10 years, I've been working on the buy side. So at first, I was with a strategic acquirer of healthcare practices. And most recently, I was with a private equity investor that was focused on dental and veterinary practices. I'm very happy to be a part of the TUSK team and to be here today.
Maggie, I could not be happier to welcome you. Welcome to the team.
Thank you.
And thanks for joining the conversation. Brian, as always, a pleasure to connect with you. I thank you for making time in your busy schedule. I'm sure your team, as well as ours, is fighting for sleep in this rapidly consolidated space. How are you? How are things going?
Oh, Kevin, it's always a pleasure to be here, and I really am excited to be here with you this evening. You know, it is. We've been looking at these proposed tax changes for a long time. You and I have talked about this on at least 4 or 5 dental segments that I can remember, maybe more. And, you know, it's a dynamic situation. Things keep changing. I know we're going to go through all the details, but, you know, there's no bigger priority probably for me and my clients right now than watching this tax situation very, very closely because it's very, very dynamic. And I think there's yet another proposal out there. And I'm, very excited to talk to you and Maggie and Rich about it tonight.
Thanks, Brian. It's always good to connect with you and appreciate it again. Rich Lieberman, we've had the pleasure of working together on multiple transactions, and you are so good at creating tax efficient structures and ways to really help our clients who both have S Corps and C Corps build transactions in ways that don't create overburdensome tax situations. I had the pleasure of reading your most recent article about the tax proposals from the House and Ways Committee published recently from Dykema. You were angry, you were frustrated, you were clear, you were curt. It was an outstanding read. For those of you who have not found it, please go to Dykema's website and download it. Rich, could not be happier to have you. Thank you for joining us.
Thank you, Kevin. Appreciate it.
You're a lot calmer in person than on the page, my friend.
Well, we haven't started yet. Let me warm up. I get angrier as we go along.
Yeah. Well, you'll be in good company. So just a quick disclaimer. This is something I think is important to share with you all. What we're going to be discussing is the proposal that was circulated on September 13th. This is still a work in progress. Things could still materially change as the bill continues to go through a legislative process. But I felt like it was important for us to take stock of what's currently on the table. We're really up against a ticking clock here. And there's certain things you need to be aware of today, certain things that you can plan for before the end of the year. That's really what Rich is going to cover. Just keep in mind that this is a work in progress and it is not done until it is done. Rich, any other disclaimers for our attorneys? Brian, any other disclaimers we need to add here?
Well, I mean, it's a ticking clock for us because the year is going to end and people have to figure out what they're going to do before the end of the year. But the one thing I would emphasize is it's not a ticking clock for Congress. I mean, they're debating this, and there's a lot of details and moving parts we're talking about. They're really not under any pressure, and some, all, or a little bit of this may or may not pass. So the ticking clock, Kevin, is really for our clients to sort of figure out what makes the most sense for them before year end based on the best available information.
Yeah, well said. And Rich, I want to just give our audience a preview of what to expect today. Worked real diligently with you and Brian on this list, and I love how we've broken this out. So there are really four things we're going to be covering over the course of our time together tonight. One is the items of importance to individuals and businesses that are effective now, today, that you may or may not be aware of. Two is what's not in the current proposal that was in the Biden proposal. And there are actually some wins here. So there's some interesting takeaways here that it could have been much, much worse. Three is what do you need to do before the end of the year with your tax planning, with your CPA, with your legal counsel to ensure that you're prepared. And four, what's the impact to the M&A markets in 2021 and beyond. So we've got a great agenda for our time together tonight, and would like to really just start off with the first question here for Rich. So Rich, what items should we be focused on as business owners and as individuals now with this current proposal on the table?
Let me start by saying I think we need to put one caveat in here, and that is while there is a House Ways and Means Committee that is tilted towards Democratic control, there is also a Senate Finance Committee that is evenly split between Republicans and Democrats, and they don't have to follow anything in this proposal. The Senate Finance Committee can do whatever it wants, and to the extent that it is inconsistent with the House proposal, there'll be a conference committee that will work to knock out a compromise. Most important are two senators, right? Manchin and Semino. And regardless of what happens here, they have to approve. And right now, they're not in alignment with much of this. So let's talk about some of these things that they're not in alignment with. And let's start with the capital gains rate. So as has already been alluded to, there is an important proposed change to the capital gains rate. The Biden administration said effective for transactions occurring after April, on or after April 28th, the capital gains rate would rise to 39.6% on individuals with ordinary income above $1 million, taxable income above $1 million. The new proposal says that the rate would be increasing from 20 to 25% effective after September 13th, a week ago Monday. Now, what's important to understand are two things. First, the rates. So in terms of the proposed rates, if we're talking about the highest rates, then for those who have gains on or prior to 9/13 and married filing jointly, taxable income for the highest rate is $628,000. Whereas under the new proposal, that income would be $450,000. So I'm simply pointing out that for many of our listeners, they'll be above this threshold, God willing, in terms of transactions. But nonetheless, it's both a combination of not only increasing the rate from 20 to 25%, but it's lowering the taxable income base from 628 to 450. So I'll start with that. And
Rich, let me stop you for a second, okay? Because I just want to, for context, talk to everybody. Biden released something very early this year, and I think it's an important context because Kevin made the remark, it could have been a lot worse. So let's talk about that for a second. When Biden released his initial proposal much, much earlier this year, he suggested that the capital gains rate could be as high as something like 43% or something outrageous like that. That really concerned people. He suggested some of this could have a degree of retroactivity to it to this year, and that got everybody, really in a panic, for lack of a better word. It sounds like the proposal that's on the table right now, and I think you made a great point, Rich, because Senators Manchin and even some other Democratic senators said they're not even on board with this. So there may be some more negotiation, but at least the proposal that's on the table right now appears to say that the capital gains is going to be from 20 to 25%, not 43. So it sounds like that 43% thing is off the table. And it does sound like under the current proposal, it would be retroactive only to things that occur after September 13th. So if you've already closed your transaction this year, it sounds like you would be safe at the existing rates. And I just wanted to ask you, Rich, is that a pretty good summary sort of where we were based on the guidance that was released much earlier this year that got everybody really concerned?
Yes, it's a very good summary. And this is what Kevin was referring to with my rant and our alert, which is that I find it very troubling that the government would say to our audience that the increase initially would say the increase was effective April 28th. And since we're telling you this after April 28th, it's now too late for you to do anything. And next, we have the House come out and say, no, not April 28th, September 13th. So all of you who took the government at its word and did not do anything subsequent to April 28th, well, gotcha. It's too late again for you to do anything. And I just can't quite reconcile how the government can actually say that with a straight face and enact this provision. The other thing is, people don't understand transactions don't necessarily occur on the date you think they do. And what I mean by that is, and I'll use a partnership transaction to illustrate, when you receive a distribution of money from a partnership, and that distribution of money exceeds your basis in your partnership interest, you have capital gain. And so let's say that capital gain occurred, that distribution occurred on April 27th. So we're ahead of both of these dates. Well, for income tax reporting purposes, that capital gain isn't treated as occurring until December 31st. So all of a sudden, you had a transaction before either one of these dates, but now you're thrown into this retroactive situation simply because of the manner in which it's recognized for income tax purposes. So for me, this is just more troubling than simply increasing rates from 20 to 25%.
I think we're going to have a little faith here. I mean, obviously, we don't have a crystal ball, and nobody on this particular segment can predict with certainty what's going to happen. But if, common sense and good judgment ends up having anything to do with it, and sometimes where Congress and the government is concerned, it's got nothing to do with it. But if common sense and good judgment has any say in this, I got to believe that when the Senate, looks at this and they reconcile this, wouldn't the easiest thing to do for whatever change they make just say, look, it's effective January 1? Because, I mean, you've got so many folks right now. We're having one of the busiest M&A for, end of third, fourth quarters that I've ever had in my career. And likewise, we had it last year because everybody's scrambling to try and avoid, some type of unpleasant tax consequences. And this, Rich, turns it on its head because everybody that's staying up all night and working so hard right now to get their deal closed by December 31st. If this thing is true, the government would give you a big gotcha. I know you worked real hard and you closed it by December 31st, but because you closed it after September 13th, we're going to retroactively hit you with this, is what it sounds like, Rich.
Absolutely right. And that's why I'm just so frustrated by all of this. But to your point about common sense, one of the interesting aspects of this bill, and we're going to talk now whether there is common sense. This doesn't there was a provision in the proposal that says that if you're an S corporation and you want to switch to a partnership, now traditionally you can't do that because Code Section 311B comes into play and treats that change as if appreciated assets were distributed to the shareholders who then contributed those assets to a partnership, and the distribution from the S corporation is treated as a sale event. Well, this proposal says, go ahead, you have 2 years beginning January 1st, 2022 to make this transition without a tax impact. But there's a hitch to all this, which is your S corporation must have been in existence on May 13th, 1996. Now, for the life of me.
So Rich, just
Yes.
to unpack that before we get into too much, crazy tax details. The bottom line with this for anybody listening is there could possibly be a workaround if your corporation was in existence in 1996.
Well,
right?
Yes, that's if you had an S
what I'm saying is,
corporation.
if you haven't been around for decades and you're somebody that's entered the dental space in the last 10 or 15 years, and there's plenty of people that have done that and done very well, then there's not going to be a workaround, if I'm understanding you correctly.
Well, I'm not so much talking about a workaround as simply saying that there's a lot of nonsense in this bill, and this is one of those nonsensical provisions that applies really to a very limited audience. This was put in for someone. And these are the kinds of things that bills do. They put in very narrow provisions that apply to only a limited group of taxpayers because the Constitution forbids direct benefit to individual taxpayers. So I don't want to delay us on this or delay us, but rather simply say that there's so much in here that I think will ultimately be changed. And at the end of the day, I think a lot of this is going to come down to Manchin and Sinema in terms of the Senate. And let me just go on and mention that, just so everybody understands, something that will become effective with respect to the 2022 tax year is now a 3% surcharge on high-income individuals. And a high-income individual is someone with modified adjusted gross income in excess of $5 million if married filing jointly. And Brian, this goes to your point about the 43.8% or 40, whatever it was before, which is the net investment income tax of 3.8%, which did not apply to S corporation shareholders who are active in their business. So dentists who are shareholders of an S corporation have not been subject to the 3.8% net investment income tax, and on their transactions would not have been. But guess what? It is now applicable to the S corporation shareholders. And once again, it is the same magic transition dates back to September. So technically speaking, then the rate isn't the 25%, the rate is 28.8%, plus potentially, if you're over the 5 million mark, subsequent to this year, another 3% surcharge on top.
So to make that a little more understandable, as I'm understanding it, you might get hit with a one-time tax. In other words, like, let's say you're a dentist and you're making under 5 million generally, but you do a one-time event where you sell your business that you've built from the ground up for a long time, for an amount in excess of 5 million. You will get hit with that one-time surcharge on the transaction. Am I understanding that right?
Absolutely right. And now add that 3% to the 28.8 I just mentioned, and you're over 30%. So even under this new proposal, but again, that 3% surcharge comes into effect beginning in 2022.
Yeah. So if you got your deal done, by the end of this year, you could avoid that surcharge, it sounds like.
Yes, and so therefore a reason to, if you can, to get that deal done, even if for whatever reason the government stays with the September 13th transition date.
So you might get retroactively hit with 25%, but you could avoid the all these surcharges. So, I mean, the bottom line, Kevin, Maggie, is if anybody thought we were going to get off this call and get to go to sleep and take a rest for the last quarter, I don't think that's in the cards.
No,
Not happening.
Yeah, that's exactly right. I mean, if you have a deal that's in process right now, I think it is stay the course. There's uncertainty clearly in this bill, but it doesn't feel like there's any reason to hit pause on a process. Get done what you can get done this year, and then we'll see where we're left in 2022 once these bills get squared away up in DC?
I mean, my personal feeling, I mean, again, I don't have a crystal ball, so, I cannot tell anybody listening with certainty, but my personal feeling is there's a pretty good chance, based on the public statements that, Senator Manchin and some of the other, more moderate Democratic senators said, that, maybe this retroactivity is not going to be the final say on it. When the Senate actually looks at this, maybe they're going to get rid of the retroactivity to September 13th. But even if they don't, there's enough surcharges that they're planning on tacking on in 2022 that you can clearly avoid those by getting your deal done this year. So yeah, I mean, my advice to anybody that's in process or in a position to get their deal closed is, no matter what happens, you're going to be better off getting your deal closed this year than in 2022.
Yeah, agree with you there. Rich, are there other things that anything else that individuals and businesses need to be aware of that are effective today, that are in place today?
Nothing that we should focus on for this particular audience with respect to today.
Okay. All right. So there were some big changes from the original proposal that Biden shared with all of us to where we stand now in this proposal. What are the big differences there, Rich?
Okay, the main differences are, first, beginning with the Obama administration a long time ago, there has been an effort to do away with the 1031 like-kind exchange rules.
Right.
And just like what's happened every budget year since then, it has died. And so there is nothing in this House bill addressing a release of a departure from the current regime for 1031 like-kind exchanges. The most important, though, difference between the Green Book, Biden's budget proposal, and the Ways and Means proposal is that Biden called for an elimination of basis step-up. And that is not in this proposal. And most likely it's because several former senators were brought in to lobby on this issue and were clearly very successful in keeping basis step-up, which kind of leads us into the next section, if you will, of this report, which is what you need to do before the end of the year. And part of that is connected to this fact that the elimination of basis step-up is not in the proposal and is not going to be in the Senate Finance Committee proposal either. So really what we're now talking about is some estate planning. And from an estate planning perspective, it's really important to understand that beginning next year, we're going to see a change in the estate planning opportunity, because right now there is what's called a unified credit, or just think of it as your combined lifetime gift and estate tax exclusion, which is $11.7 million per individual. And so from a married couple point of view, we're talking about just about $24 million of total value that you can do something with, you can get out of your estate through gifts, etc. Well, what's going to happen is, under this proposal, beginning January 1st, 2022, that unified credit is going back to where it was in 2010, and that's $5 million per person, or a total of $10 million for a couple. And so that really does bring to the forefront the need to think about how significant that change is, and to do any estate planning that you want to do this year. But going along with that, they added something in the House proposal that is very troubling, and that is many people use grantor trusts. And the purpose of a grantor trust in many ways is simply to gift assets today to a trust. For income tax purposes, if it's a true grantor trust, it's disregarded for income tax purposes. So the income tax consequences of that asset continue to be reported by the grantor. But it is, for gift tax purposes, an effective gift in the year of transfer. And so therefore, one is able to move that asset out of their estate. They're able to retain control over the asset. and continue to pay the income tax. There have been a lot of studies that have been done that have said that, frankly, the ability of the grantor who has the financial resources to continue paying the income tax is a huge benefit to the trust, because that keeps more cash in the trust, which it can invest. Well, what House Ways and Means Committee is proposing is to eliminate all of that. And there will be no more grantor trusts in the nature, in the manner in which I described. They're going to say that to the extent that you continue to maintain, quote, control over the asset, that the asset will continue to be in your estate, and there won't have been an effective gift. And so those are very important considerations. This also applies. So this applies to grantor.
Rich, let me ask you a question here. So these are major changes and major rollbacks, and a lot of people have spent a lot of time and money building their estates, building their trust, planning for gifts to dependents without step up in basis, putting grantor trust together. What can I do? How do I attack this problem? Is this picking up the phone and calling you? Is it calling my asset manager? What do I need to do in reaction to all of this?
So what you need to do is to consider removing valuable assets from your taxable estate by the end of this year, because to the extent that a grantor trust is established after the end of this year, then anything that happens with that trust is not going to get the benefit that current grantor trusts are getting. With respect to existing grantor trusts, they will remain in effect and they will continue to get the benefit they previously received. However, they will not continue to get any benefit with respect to post 2021 asset contributions. So it is really important that putting these two things together, the significant decrease in the unified credit and the loss of grantor trust protection after this year means that prior to the end of this year, it is very important to connect with your financial advisor, your estate planner, your accountant, whoever it may be, to talk about what can you do to minimize the impact of the estate tax on your estate, so that your survivors, your heirs, will be able to inherit something that you've worked very hard, right, to achieve, and not just give it all away to the government upon death.
Brian, I want to bring this to back to dental and back to DSOs. You and I have worked on a couple of transactions and are talking with a couple of clients right now that are building or have built regulatory compliant DSOs with DICOMA and are working to provide or gift those shares to trusts that will be owned by heirs. And doing so in currently real tax efficient manners. Does this put an end to all that, Rich?
After this year, yes. And let me just add one last.
I mean, assuming it all passes, Rich. I mean, that's what we have to say. And that's the sad thing about this, right? I mean, we're doing our best to provide the most current information to the audience, and we'll continue to do that. But is it possible, Rich, that some of this won't ultimately end up in the final bill?
It absolutely is possible. I mean, this is all just right now what I consider to be a wish list.
That's well said.
And in fact, what's happening is a lot of this is intended to support a $3.5 trillion expenditure. But we're clearly seeing that while the progressives on the left are seeking 3.5 trillion or more, the moderates on the left are saying 2.5 is more than enough for us, and Joe Manchin is saying 1.5 is more than enough for him. And so it's likely that the 3.5 will not end up being the final budget. And as a result, some of these provisions would not then be needed to support such a large amount. And let me conclude the tax part by simply saying that one last important point that would go away if the wish list was granted, which is we often will set up what are known as family limited partnerships. And these are transactions where we have two classes of interest, A and B, and parent will have A and children will have B. A is the only one that votes. And so what happens is parent will gift some of those interests to children. And we often apply discounts to the value. And those discounts are for lack of marketability and minority interest. And the Internal Revenue Service has long agreed and accepted that discounts between the ranges of 30 to 40% won't get attacked, and they will be upheld. It's only when you go above that that they'll really challenge. Well, under this proposal, they're saying that after 12/31, all of those types of discounts will now be eliminated. So yet another reason to think about whether, if you were thinking of doing a family limited partnership, the only reason to do it is to take advantage of those discounts and to be able to move more value with less gift tax consequence. And so therefore, if that's in your planning portfolio, that's something that needs to be accelerated.
You know, Kevin, I'll say this though, at least the current parade of horribles is much more manageable. You know, at the beginning of the year,
Could have been worse.
Yeah, right, Maggie, right. At the beginning of the year, when they came out and said they're going to raise this to 43.6%, I mean, that would be cataclysmic to the M&A markets. I don't know how you would manage that. It would just be like, you know, devastating. But if what you're talking about is, look, there's going to be a 20 to 25% increase on capital gains. It may end up being better because this negotiation is far from over, but you're looking at about 5% and potentially a surcharge, and we can write in some exceptions to the surcharges. You know, there's so much demand, an insatiable demand for DSOs and profitable group practices right now in the marketplace. And there's so much competition for these. This amount of money, I think, can be baked into the purchase prices in 2022. You know, the ones I feel the worst for are if this held up, and I have a big question as to whether this is going to end up being retroactive. I have a big question as to whether that will be the final say on this. But if it is the final say, you know, and somebody basically is in process and they close their deal now at a previously negotiated price, you know, they may end up with more taxes than anticipated. But for everybody in 2022, at least, I think you can bake in an extra 5% to the transaction price, or you can split the difference, or there's a lot of things you can do to mitigate this. So in the end of the day, it's not going to have a material effect on the M&A market. I mean, that's sort of my, you know, initial thoughts when I hear where we are now compared to where we were at the beginning.
Yeah, Brian, that's really well said. And I think actually our next slide will illustrate that exact point, and just help walk the listeners through.
Hey, Maggie, can
what it
I
actually
interrupt
means.
for 1 second? May I interrupt for 1 second, Maggie? I think I said earlier that the net investment income tax would be the increase with respect to S corporation shareholders. Application to them would be effective a week ago Monday. That if I said that, I didn't mean that. It's effective after this year. So if you're an S corporation shareholder, you will still avoid that 3.8% addition. I'm sorry to interrupt.
Okay, no, thanks for the clarification.
Yeah, back to Maggie's point, Brian, we like to quantify things over here. We live in Excel. So I was, you know, poking around in Excel this morning and pulled together a pretty simple model to articulate exactly what you just described. So here we're looking at, let's assume this is today, max ordinary income tax rates of about 37%, current long-term capital gains at 20%. This is $1 million EBITDA deal, trading at 6 times with an allocation between 80% cash and 20% equity. And the allocation of the purchase price is split 10% to fixed assets and about 90% to goodwill or intangible assets. Pretty common in our world. If you look at the bottom line here, and we've assumed a return on invested equity of 3 times. So for the dollars that were rolled into equity, we're assuming that they're going to return that doctor 3 times that. After we run it through the current tax code, the after-tax total proceeds are about $6.3 million. If we look at the increase in ordinary income taxes to 39.6 and an increase to long-term capital gains to 25%, there's a decline and the after-tax proceeds. In total, it goes down by about $465,000. Some of that's from cash, some of that's from the equity. But what we started thinking about is, okay, this is not as bad as we thought, but what's the answer? Well, we all know that in valuations, there are really two functions that drive value. One is what's the EBITDA, and second is what's the multiple. So we had two variables to work off of to try to get back to these 2021 levels. We took that same $1 million of EBITDA and said, what multiple would we have to achieve in the market in order for us to net $6.37 million of after-tax proceeds, this number down here at the bottom. And the increase in multiple is less than half a turn. And Brian, I can tell you, we're seeing deals trade up well beyond what we thought they would trade at the middle of this year. I think market demand will more than accommodate a half of a turn in a competitive process. So that's one way.
We're going to be fine for 22, Kevin. I mean, I think these numbers are terrific that you guys put together, but I think that's exactly right. Competition will, basically more than make up for this, 5% or whatever it ends up for 22. What I can't help but think about though is it would be horrible if you close your deal in November or December and they don't eliminate this retroactivity, and you've closed your deal at the old negotiated price, and somehow you have to disproportionately get punished. I mean, that's, I don't want to go on my own rant, but, retroactivity is a horrible tax policy. It really, really is.
Yeah, I couldn't agree with you more. Look, this is tax changes and tax increases are unpopular enough. So, I think we need to let the market understand what the proposals are and prepare for these in order to have the least disruption possible inside of the U.S. economy. And by rolling these dates back to the new year, I really think that would accommodate that. There's still going to be anger and frustration, but if we can get a little bit of lead time and let everyone prepare, at least it would be digested a little more seamlessly in the U.S. economy. I mean, that's the hope, right? Hey, let me just finish this one thought off here, Brian, and then we can get back to the big takeaways. But in this first example, we moved the multiple up by about half a turn. The other way to think about this is keeping the multiple fixed at 6 times and seeing how much your EBITDA would need to improve to put you back at that same after-tax proceeds number of $6.37 million. And look, it's $78,000. It's not nothing, but that seems relatively attainable, probably something that could be achieved in maybe a year and a half of simple 5% growth year over year. So we don't view this as a major headwind either. I would be sick to my stomach for any of our clients who get to the finish line this year and are hit with this. I know the government's not fair, but that would make me sick.
I think the other key point is that, the second assumption is that multiples stay the same, and we just don't know. We don't know what the future will hold. We do think that multiples will remain the same for 2022. That's, close enough in the future that, based on the trends we're seeing today, we anticipate that will be the case. But I think it would be just important to remind everyone that, waiting a couple of years and trying to grow your practice does leave a bit of uncertainty. If you are, interested if you're ready to sell today, I think it behooves you to make sure that the process is competitive so that you can get the maximum multiple and maximum value for your practice.
Yeah, I mean, I think if you were always going to wait 3 or 4 years because that's where you are in the life cycle and you were always going to do that, I don't think you have to take some extraordinary step and, cancel your long-term plans and sell right now. But if you were planning, on selling right now and you're concerned about these changes, my gut is you're going to be okay probably for the last quarter of this year. You're definitely going to be better off than in 22. And in 22, I think the competition, and I think that's critical, the point Maggie just made, the only way you can really assure competition without a ton of work on your part is to, run a process. Nobody does that better for the middle market than TUSK. But if you run a process, you're going to have people competing on things. If people are competing on things, the likelihood of your purchase price more than making up for, the increases next year, that would be the way to do it. The likelihood of that happening is a lot higher if you run a process.
Yeah. And listen, I mean, I'm new to the TUSK team. The reason I joined TUSK is because of their, demonstrated ability to maximize value for sellers. And I think, Kevin, what is it? Over 40% of an increase in value that TUSK has achieved. And so if you're wanting to recover from these anticipated tax changes, find an advisor. TUSK is one of them that can help represent you and make sure that, all of the potential buyers are seeing your deal.
That's a really good point, Maggie. I mean, we're in constant contact with the buy side, and they say they're busier than they've ever been, and they've been very, very persistent with their unsolicited offers this year, and that's great, right? They've been able to build a robust pipeline, and I think a little bit of that could have been fear-based, right? You need to close before the end of the year. Taxes are looming. The long-term capital gains rate could double. The sky is falling. Do it now, or you're in trouble. And then come to see what could be ahead of us. It's really not as scary as it once was.
No, it's not. And, if you're not already in process, it's highly unlikely you'll close your deal by the end of this year.
Yeah.
But that shouldn't scare you, right? There are fewer sellers because so many sellers have been, I think, nervous about these tax changes and decided to go ahead and execute a deal this year, which is great. But that's also great for those who didn't sell, because that means there are fewer practices for buyers to chase. And so that increases your negotiating leverage and will allow you to command a higher price for your practice.
Yeah, I just think about 2021 alone, we've partnered 3 groups with new private equity groups. So we played a role in the creation of 3 new private equity backed groups, and that we're not the only one doing this, right?
Right.
So Brian, I don't know how many you think there are out there. It's got to be well over 100 by now, private equity backed DSOs that are looking to grow at scale, and they've got real rich pipelines that they are getting through this fourth quarter. Your attorneys are working around the clock. CPA firms and their quality of earnings teams are working around the clock. And they're at the stroke of midnight on New Year's Eve, a lot of that work is going to be completed. And I think what sometimes goes missed is those buyers are still going to be sitting there ready to buy on January 2nd.
Well, no, I mean,
business.
Yeah, I mean, here's the thing. It's not even, there's well over 100 PE-backed DSOs now, but that's not even the issue. I mean, that is an issue, but the issue is there's probably well over 100 that want to get into the market and it can't, and they've been shut out. And, you're seeing sometimes a lot more enthusiasm and aggression where if a particular fund gets shut out, and I know of a couple examples, obviously we won't name names on a show like this, but I know of a couple examples of folks that got shut out and they took second place in 2 or 3 transactions in a row. And it doesn't surprise anybody with on transaction number 4, they way overpay just because they're tired of being shut out of the market and they want to do a deal. So all those folks will be there on January 2nd. The PE groups that are right now in the market have platforms that are looking to expand, and the folks that have gotten shut out or want to come in. I mean, dentistry, as you know, Kevin, we've been talking about this for, 10 years almost, has been, virtually recession proof. It proved after an initial hiccup that it's pandemic proof. So as a result of all that, it's going to be one of the best investments out there in the US to do, really internationally too. We're seeing it. They're starting to learn this in the UK and in Australia and in other places. So it's a very strong sector to invest in. So all those folks will be there January 2nd, plus the of folks that are left out and want to get in on the party. So if you don't close your deal this year, and I agree completely with what Maggie said. I mean, if you're not in process right now, absent a Hail Mary miracle or something, you're not closing this year. I think you'll have an opportunity to sell in 2020. I think there'll be lower inventory, so there'll be more competition. And I think that should come pretty darn close to offsetting any of these tax issues we've been talking about.
Absolutely. And, as you said, Brian, I mean, these private equity backed DSOs continue to need to grow in light of any tax changes that go into effect. So, they're part of a fund. They've got to return capital to their investors, and that means continuing to scale and grow and invest capital, whether that is in their existing DSO platform or creating a new DSO platform if they're not already in the market. And so they need to continue to grow. They're going to be offering, likely more and more attractive multiples to practices as the inventory decreases. So I think there is, a lot of opportunity for sellers in 2022 and beyond.
Guys, I could talk about this all day. I mean, I so enjoy getting the insight from Rich and Brian and Maggie, from you, looking from the buy side's perspective now. I mean, we're really getting a whole 360 look now at what's going on in the space. This is awesome. Rich, I know you've got calls to take, and you've got a long list of work ahead of you in light of what's going on. So thank you for making time for us. Can't thank you enough. You might have already had to drop. I know he had lined up.
I got a text, Kevin, that he had an urgent tax call to attend to. So Rich may have already taken his leave of us, but he did a great job, I thought, explaining everything to us.
Yeah, he was excellent. Well, we will, Brian, thank you for your time. Obviously, this is a story that is still being told. And as we get more information, we'll be sure to reconnect with you all and share with everyone the latest and greatest from your friends and mine up in Washington, D.C.
Absolutely. This will not be the last time you and I get together. The fun part is I'm really, really excited. If you don't know, that Maggie joined TUSK. I know she introduced herself earlier, and I just look forward to working with her on some of these transactions. You've got a great, a great addition to your team there, Kevin, and I'm predicting this will not be the last time all of us get on here to talk about taxes.
No, I can't imagine.
Definitely not. Brian, thank you. I'm looking forward to working with you as well.
Great. Well, thanks everybody for joining us again. We'll have a wonderful evening and enjoy the rest of your night. Thank you.